Let's start with the markets, which are lower on this first trading day of the new year. The big question is whether we can see a repeat performance for 2025 like we've just come off of for 24 and 23. Our next guest says any disappointment, any slow... What? You don't like that intro? Any disappointment or demand slowdown in NVIDIA and AI is the single biggest risk facing investors. Is it not, Dan Greenhaus?
I did say that.
Yeah, okay. Well,
then what's your beef?
I just giggled at, I'm happy to be here.
Welcome.
With you. What a wonderful...
It's too late now.
Okay, I'm sorry. No, I did say...
And NVIDIA is in the green today, so we can take that.
It is, and it's in the midst of a little bit of a sell-off here, down 10%, 8-10% from the high. But listen, I'm not breaking any news by saying a demand slowdown in AI is the single biggest risk. So much of those mega cap stocks are a derivative of that story. And if something were to happen there, obviously it's the biggest risk facing markets. I know we like to talk about tariffs, but that's really it.
Wouldn't you say that? I mean, I could say the biggest risk would just be economic slowdown, or Barry Knapp last hour. No, biggest risk is rates backing up because of more term premium, deficits, that kind of thing.
No, I think they're wrong, especially Barry Knapp, who I have nothing but great respect for. Listen, yields are a rally.
The man's not even here to defend himself when you're dunking on him.
I'll call him later. Listen, yields are certainly a risk to market. Obviously, the last time we got up to 475.5 at the end of 22 was a bit of a problem for markets. And anytime yields go up too quickly, it's a problem for equity markets. And certainly an economic slowdown, given the relationship between broader growth and S&P 500 revenues, yada, yada, also a bit of a risk. But from my standpoint, again, so much of the work, and it's not just NVIDIA and Broadcom, it's Eaton, and it's a number of companies, it's Vistra, it's all those AI derivative plays that have done so exceedingly well, helping the so-called other 493, which I think is a stupid name, but whatever. All of those are derivatives of the same story. If something were to happen there, I don't see how that is not the biggest risk.
But is the risk that the rate is X, or is the risk that the rate has gone up so fast, and the reason why the rate has gone up?
Of course. I mean, listen, the reason it goes up is the biggest issue. If yields are going from, let's just say, 4.5 to 5, or 5.5, or 6, because the U.S. economy explodes through some productivity miracle and everything's going wonderfully, then fine, that's not a problem. If it goes from 4.5 to 5 or 6 because suddenly the U.S. government has to issue $8 trillion in gross debt next year instead of $4 trillion or whatever the number is, that's obviously a different risk. Now, that said, the inflation story, from my standpoint, I know it's a big risk, and obviously tariffs are complicating the issue somewhat. The inflation story seems contained to me.
Agreed.
Contained at a level above the 2% target that the Fed is going for, but contained nonetheless. And so if I'm an economist, I'm worried. 2.5 is not acceptable. 3 is not acceptable. But if I'm an investor, I don't really care. 2.5 is fine as long as it's stable there. Even 3 is fine if it's stable there. And in fact, that's what you've seen over the last couple of quarters.
I'm just checking on the TIPS yield because we did see a lot of movement there the past couple weeks. And to your point about the other 493, and this was actually a point Barry made, so I'll give him some credit. When we see the TIPS yield rising, that's when we tend to see the mega caps outperform, right? No one wants to own anything else in a world of sticky inflation. No one wants to own the Russells, for instance. So we've seen a little bit of relief. There's the chart. It hasn't come down a lot yet. So there is something in the market that is it doesn't like your 3% as much as you do.
Listen, the one caveat I'll offer to this conversation is I think when we lump, and I just did it, so I'm partially to blame, but when we lump everything in as the other 493, it misses that there are a ton of non-AI stories that have been playing out in markets, irrespective of what the Fed is doing, irrespective of what the government is doing. The insurance stocks are doing super well. A number of industrials are doing well. GE Vernova and some of those new energy stocks are still doing well. I know we lump them at consumer-related names. Look at Expedia and Booking, for instance.
The cruise lines?
The cruise lines.